Good morning and welcome to the Bills, Bears, and the Bill Morning edition of the Deep Dive. Thank you for joining us.
Great to be here.
We are tearing into the final pre-market briefing of a week. It's Friday, October 3, 2025.
The end of the week, and definitely feels like one report is hanging over everything.
Yeah, if you're watching the tape this morning, you already feel the tension. We are operating in a highly anticipatory state, a market on a nice edge, really.
Yeah.
Defined by positive but incredibly fragile momentum.
Fragile is the word. You see these modest gains, S&P futures up a bit, Europe too.
Right. We see modest gains across U.S. and European futures, but those gains are like holding their breath, aren't they?
Completely. Everyone's wary.
So our mission today is laser-focused. We are unpacking the sources that unanimously identify the single dominant catalyst driving global markets today, defining the three possible outcomes, and, most importantly, giving you the strategic framework needed to navigate the inevitable volatility that slams into the market, starting precisely at 8:30 a.m. Eastern Time.
Yeah. And that fragility you mentioned, that's the key word.
Yeah.
When we look at the hierarchy of market drivers this Friday, there is literally one item.
Just one.
Just one that stands head and shoulders above everything else. It's completely eclipsing all the corporate earnings news, any secondary economic data releases.
Yeah.
That central focus is the U.S. Employment Situation Report, the jobs report.
Yeah.
Think of it this way. Every asset class right now, from the yield on the 10-year Treasury note to, the valuation multiples of the most aggressive NASDAQ growth stocks, is merely a temporary placeholder, just waiting for the single data release.
Wow. So it dictates everything.
Pretty much. This report has the capacity to either validate the long-cherished soft landing narrative,
Which has fueled this recent rally.
exactly, or it could trigger a sharp monetary policy-driven reversal across the entire financial system, literally within minutes of its release.
Okay.
This is the moment of truth for the week, no question.
Okay, let's unpack this main event then. Because, for an informed audience like ours, we know this isn't just about the headline number. This is the non-farm payrolls, the NFT report.
Right.
And it has the power to either fuel a dramatic year-end rally or, slam the brakes on market sentiment entirely.
Absolutely.
For this hour, the macroeconomic picture is the entire story. Corporate news just isn't cutting through.
No, not today. And we must look at the components meticulously because the market doesn't just react to one number. It simultaneously digests and prices in every single data point at 8:30 a.m. ET.
All at once.
Instantly. So let's start with the headline, non-farm payrolls figure. Now, it's important to remember what NFP actually is. It's a measure of the total number of paid U.S. workers, but it excludes certain groups.
Right, like farm workers, federal government employees, military.
And proprietors, too. So the consensus forecast today is for a gain of 50,000 jobs. 50,000.
50,000. Okay, the context of the U.S. economy, that sounds pretty small compared to the 250,000 jobs we were seeing in previous cycles, right?
It does.
So what does that consensus number signal to the market? What's the interpretation?
It signals a substantially cooling labor market. That's the key takeaway. The sources note that while 50,000 is an increase from the prior month's 22,000,
Which was really low, maybe an outlier.
probably revised, yeah. It was abnormally low, but still 50,000 remains far below the levels needed to, just keep up with standard population growth.
Which is usually estimated around, 150K a month?
Somewhere in that ballpark, yeah. Between 100,000 and 150,000 jobs per month. So, crucially, the market wants confirmation that job creation is slowing down. Just enough.
Just enough to ease wage pressure.
Right. Without tipping us into recessionary territory. That's the soft landing confirmation everyone is praying for.
The Goldilocks number.
Pretty much. Now, if the number comes in wildly high, say, over 100,000, the market immediately interprets that as demand remaining too robust.
Which means inflation fears spike again.
Instantly. And if it comes in negative, well, then we immediately transition to fear of a hard landing, which is scenario C we'll talk about later.
Okay. And speaking about that delicate balance, what about the unemployment rate? Because if job creation slows too much, we start tipping into those recessionary fears you just mentioned.
Yeah, that's the other side of the coin. The consensus expectation for the unemployment rate is that it will remain unchanged at 4.3%.
Stable.
Stable. And that stability, particularly given the slowing pace of hiring, would be a highly reassuring sign. It's sort of equilibrium.
Okay.
But any unexpected spike, say above 4.5%, that would instantly shift the focus. It wouldn't be disinflationary cooling anymore.
It'd be imminent recession.
Exactly. Regardless of what the Fed might do next, the fear takes over.
We also need to remember the participation rate. Why is this often overlooked metric? I think it was last rated 62.3%. Why is it so important right now, especially in the fight against inflation?
Ah, good point. The participation rate is a key counterpressure to wage inflation. It's about labor supply.
Okay.
So if more people who were previously sidelined, maybe due to the pandemic or early retirement or whatever reason, if they re-enter the labor force,
More people looking for work.
exactly, the available supply of labor increases. And a rising participation rate helps to alleviate upward wage pressures, even if the economy is still adding some jobs.
I see. So it allows for growth without overheating wages.
Precisely. If we see that rate ticking up alongside stable unemployment, it's a very positive, non-inflationary signal of market health. It allows the economy to grow without, overheating the cost side of the equation.
That really deepens our understanding of the labor market structure. It's not just the number of jobs.
Not at all.
But that brings us to what the sources identify as arguably the most critical nuance of the entire release, maybe far surpassing the NFP headline number.
I'd say so, yes.
Average hourly earnings, or wage growth. Why is this specific component the definitive signal for the Federal Reserve and, financial markets today?
It's critical because it bypasses all the complexity of job counts and participation rates. It acts as a direct, immediate input into the structural inflation models the Fed uses.
Okay, direct input.
Yeah. NFP tells you about the quantity of jobs being created, right?
Uh-huh.
But average hourly earnings tells you about the cost of labor. And costs are what drive persistent, sticky inflation, especially in the massive U.S. services sector.
Explain that difference in persistence. Why is service sector wage inflation so much stickier than, say, the price of gasoline or used cars, which can swing wildly?
Okay, think of it through the lens of a service business, maybe a restaurant or a healthcare provider.
Right.
If their labor costs rise because they have to pay their employees, say, 4% more instead of 3%, that cost increase is highly sticky. It doesn't just disappear next month.
They can't easily cut wages back.
Exactly. And they can't easily fire half their staff or quickly replace them with automation in most cases. So that higher labor cost is passed directly on to you, the consumer, through higher prices for services.
And once those prices go up,
They rarely come back down. Goods inflation, like lumber or shipping container costs, that can be highly volatile up and down. But service inflation driven by wages tends to be much more entrenched, much more difficult for the Fed to control without, frankly, aggressively damaging demand.
which is what they're trying to avoid.
That's the tightrope. Therefore, the focus is hypersensitive on the consensus forecast for average hourly earnings.
Purchase.
A month-over-month increase of 0.3% and a year-over-year increase of 3.7%.
Okay, 0.3% month over month, 3.7% year over year.
Yes. Now, if we see a number higher than a 0.3% month-over-month, say 0.4% or even higher, that would be the clearest, most definitive hawkish signal the market could receive.
Meaning the Fed stays tight or gets tighter.
Correct. It suggests that inflationary pressures are not dissipating quickly enough, forcing the Fed to maintain or potentially even intensify its restrictive stance.
And a softer reading, below 0.3%.
That's the dovish green light that fuels the rally.
So it's this paradoxical environment, isn't it?
Yeah.
We're not just watching for a soft landing in the number of jobs created. We're essentially hoping that people are getting paid just enough, but not too much. Because if they're getting paid too well, the entire stock market might punish them for the implied inflation that comes with it.
Precisely. You've nailed the paradox. And that paradox is what makes trading this report so incredibly dangerous. It's a tightrope walk between cooling the economy and crashing it.
And the wage number is the primary measure of how close we are to the edge.
Absolutely. It's the linchpin today.
Okay, let's pull back for a second and gauge the overall mood before that 8:30 a.m. catalyst hits. We've established this tentative optimism. Looking at the global futures market dashboard, U.S. index futures, S&P 500, Dow, NASDAQ 100, they're all trading modestly positive.
Yeah, ticking up slightly.
Which suggests the underlying sentiment is, positioning for that favorable Goldilocks outcome we talked about.
Leaning that way, cautiously.
What's significant, though, is the slight but persistent relative strength in the NASDAQ 100 futures. They were leading the pack up about, plus 0.26% earlier?
Yep, a little bit of outperformance there.
So, for our listener, why is the tech-heavy index leading the marginal gains When the market is so uncertain, what's the dynamic?
Right. The Nasdaq, which is obviously stacked with high-growth, long-duration technology companies, is exquisitely sensitive to interest rate expectations.
Okay, rate sensitivity is key.
It's paramount. So when markets anticipate lower interest rates, or maybe just confirmation of cooling data that makes future rate cuts more likely, the valuation mechanics instantly favor these stocks.
Because future earnings are worth more today if rates are lower.
Exactly. That marginal outperformance you're seeing is the market betting, however cautiously, that the data will confirm cooling, which is beneficial for future value discounting in their models.
But it is only marginal, as you said.
Yes, and that's key. As you rightly note, the outperformance is only marginal. This low conviction is reflected everywhere in the pre-market action. It's not a stampede.
Let's quickly scan the rest of the world for context. What are the European and Asian markets telling us about the global mood right now? Is it supporting this tentative U.S. optimism?
International markets provided a supportive, albeit mixed, backdrop overnight. In Europe, the DAX and CAC 40 were trading constructively. Pretty positive tone.
What's supporting that?
Well, this positive sentiment was supported by the final Eurozone services and composite PMI figures for September. The data showed the services sector remaining in expansionary territory, meaning readings above that key 50 level.
So Europe's service economy is holding up okay.
It provides a fundamental level of comfort regarding European economic health, and also manufacturing resilience seems okay there too. It suggests the global economy isn't just collapsing into some kind of synchronized downturn, which, helps U.S. sentiment at the margins.
Okay, that makes sense. What about Asia? I heard it was more mixed.
Asia, however, demonstrated a clear divergence, really signaled localized factors at play. Japan's Nikkei 225 was the absolute standout, surging over 2%.
Wow, big move.
Yeah, driven by positive domestic news and just broader momentum trading there. But simultaneously, Hong Kong's Hang Seng declined by 0.61%.
So a split picture. What do we make of the Hang Seng dip?
Well, that decline is likely more suggestive of profit-taking and maybe some consolidation after a recent strong rally there, rather than a uniform signal of global risk aversion.
Okay, so not necessarily a red flag for the globe.
Probably not. The takeaway is stability and localized health in certain areas, like Japan and Europe's services, but not overwhelming uniform bullishness across the board. It's patchy.
Right. Now let's pivot to the counter-narrative. This is the part I find truly fascinating and I think speaks volumes about institutional fear. The VIX divergence.
Oh, yes, the VIX.
Yes. We have these positive equity futures suggesting optimism, right? Modest, but positive. Yet the VIX futures, the measure of implied volatility, the market's fear gauge, remain at a relatively elevated level.
Still stubbornly high, yeah.
What does this conflicting signal tell us? What does it tell us about how the serious players, the big money, are actually positioned heading into 8.30?
This is perhaps the most telling nuance of the entire pre-market landscape, and it absolutely screams of a hedged long posture.
Hedged long. Explain that.
Okay, so for the listener, the VIX isn't just about fear in the moment. It's the market's calculated expectation of future volatility over the next 30 days.
Right, it's forward-looking.
Exactly. When VIX futures remain high despite rising equity futures, it means that while institutional managers are holding their positions, they are long the market.
They haven't sold everything.
No, they haven't. But they are simultaneously purchasing significant protection against downside risk. Hedges, like options, VIX calls, things like that.
So they're buying derivatives, essentially taking out a large fire insurance policy on their portfolios just before they, potentially face the firestorm of the NFP report.
That's a great analogy. That's exactly it. They're saying, look, we hope the market goes up, we're positioned for it, but we are not fully convinced that the downside risk associated with a disastrous NFP report has been adequately priced out.
And buying that protection isn't free.
Not at all. Buying that protection costs money, significant money sometimes. And keeping the VIX elevated confirms that large capital is willing to pay that premium. They see the risk as real.
Okay, so this divergence is crucial. How does it set the stage for the reaction after the data hits?
It sets the stage for exaggerated price action. Think about it. If the report disappoints, if we get scenario B, the hot report, or scenario C, the recessionary one, that underlying cautious sentiment is validated instantly.
The fear was justified.
Exactly. The hedges that were bought suddenly become highly valuable. And the sell-off could be sharp and significant, driven not just by the news, but by validated fear and momentum selling as those hedges pay off.
Right. Conversely, if we get that perfect Goldilocks result, scenario A, how does this VIX positioning intensify the upside move, does it?
Oh, absolutely. That's where the rally gets its extra fuel, its oomph. If the uncertainty is removed, if the perfect inline cooling data is confirmed, those expensive hedges suddenly become unnecessary.
Like the fire insurance policy when the house is definitely not on fire.
Precisely. So what happens? The VIX collapses rapidly. Large funds are then forced to unwind those defensive positions. They have to sell the protection they no longer need.
And selling protection often involves buying the underlying asset.
And just freeing up capital that was tied to the hedge. This unwind creates a sharp, almost mechanical demand for risk assets equities. It adds significant non-fundamental fuel to the fire.
So it's not just relief, it's forced buying.
It sparks an even sharper, more dramatic move upward than fundamental analysis alone would suggest, because the institutional hand is forced to buy back into the market or redeploy that capital. This is why the rally, if it happens, will likely be very fast and very violent to the upside. The unwinding of those hedges acts like an accelerant.
Okay, we've really established the central role of wage growth and the nervousness reflected in the VIX. This all boils down to strategic event risk management for today. Let's revisit that critical question that connects all these dots because it's fundamental. Why does a fraction of a percent movement in average hourly earnings matter so much for the long-term valuation of companies like those in the NASDAQ 100, the tech giants?
Right. This is where we connect that single macro data point directly to the corporate finance mechanism, specifically the discounted cash flow, or DCF, model that sophisticated investors use. It's a pure causal chain.
Okay, walk us through that chain. Let's take the negative case first. What happens, step by step, if the 8:30 a.m. report is hot? Let's say strong NFP and average hourly earnings come in hot, like 0.4% month over month.
Okay, hot report scenario. If the report is hot, that immediately reinforces the persistent inflation narrative. The market instantly thinks, okay, inflation isn't beaten yet.
Fed stays hawkish.
Exactly. The market immediately prices in a sustained higher for longer interest rate environment from the Fed. The very first consequence you'll see, U.S. Treasury yields rise sharply.
The 10-year yield, for instance.
Yeah, the 10-year Treasury yield. It's often called the risk-free rate because it represents the baseline return investors demand for holding, theoretically risk-free sovereign debt.
And it's the anchor for everything else.
It's the anchor for all global financial calculations. Now, in DCF valuation, which is how investors try to determine the intrinsic value of a company, you take a company's projected future cash flows, all those earnings way out in the future, and you discount them back to their present value. You figure out what they're worth today.
Okay, and what happens when that risk-free rate, the Treasury yield, rises? How does that affect the discounting?
Simple mechanics. When the risk-free rate rises, the discount rate used in the DCF model also rises. This is absolutely crucial. A higher discount rate means future earnings are worth less today.
Okay, higher discount rate, lower present value.
Exactly. And this process disproportionately compresses the valuation multiples of what we call long-duration assets.
Define long-duration assets for us. And why do they suffer more than, say, a traditional manufacturing company or a bank?
Okay, long-duration assets are primarily your technology and high-growth stocks, especially those that aren't yet generating massive profits today, but promise explosive growth 10, 15, 20 years down the line.
Like a cutting-edge biotech firm or a high-flying software company.
Perfect examples. Most of their perceived value is tied up in those far future cash flows. When the discount rate goes up, those distant cash flows get brutally devalued in present terms.
I see.
Conversely, think about a traditional bank or a mature consumer staples company. Their earnings are already flowing in pretty steadily today. They're considered short-duration assets.
Less sensitive to rate hikes.
Much less sensitive. So strong job growth and high wages, paradoxically, can be really bad news for high-growth stocks because they imply that the cost of capital, that discount rate, is going up and staying up. It diminishes the present value of all that future potential.
So the rising cost of money basically trumps the growth narrative for those stocks.
In the short to medium term, absolutely. Valuation compression hits them hardest.
Okay, that's a critical link. Now let's apply this framework to the three possible outcomes for the 8:30 a.m. report. We've touched on them, but let's lay them out clearly. Starting with the one the market seems to be leaning towards, however nervously. Scenario A, Goldilocks.
Right, Goldilocks. This is the just right scenario, the perfect balance. Data comes in right in line with consensus, or maybe even slightly weaker.
So NFP around 50K, stable unemployment at 4.3%.
And critically, wage growth right at that 0.3% month-over-month target, or maybe even 0.2%. This reinforces the soft landing narrative, confirms the disinflationary trend.
And a market reaction.
Decisive. A sharp, broad-based rally, led forcefully by the rate-sensitive NASDAQ 100 for the reasons we just discussed.
Treasury yields fall.
Yields fall as the Fed is confirmed dovish, reducing that discount rate. And most visibly, the VIX collapses as those institutional hedges are rapidly unwound.
The fuel gets added to the fire.
Exactly. This is the scenario that sparks a major relief rally, potentially carrying momentum into year-end.
Okay. Next, the market's biggest fear. The scenario where that knife's edge we talked about really gets tested. Scenario B, the hot report.
Yeah, this is the one keeping people hedged. This involves NFP coming in well above expectations, say over 75,000, maybe even 100K plus. And critically, wages coming in hotter than expected, above that 0.4% month-over-month level.
What happens then?
This scenario instantly reignites structural inflation fears and, consequently, hawkish Fed fears. The reaction is pretty much a definitive sell-off in equities across the board.
And the NASDAQ.
The NASDAQ 100 severely underperforms. Driven by that yield-driven valuation compression we just detailed, Treasury yields spike dramatically, reflecting a market shift to pricing in potentially further rate hikes, or at least higher for much longer.
Any other effects?
Yeah, the U.S. dollar strengthens. Its yield advantage over other global currencies widens. This is the classic risk-off environment where investors run for defensive assets, maybe cash, maybe short-term bonds.
Got it. Sell everything, buy dollars.
Pretty much. Finally, the most complex and potentially confusing outcome, certainly for the average investor, Scenario C, the recessionary report. What happens if NFP is actually negative, or the unemployment rate spikes unexpectedly, signaling the economy might be collapsing? Okay. Scenario C presents an immediate internal conflict for the market. It's confusing at first. An unambiguously weak report, like negative payrolls, that is instantaneously dovish for the Fed.
Because they'd have to stop tightening, maybe even cut rates soon.
Absolutely. They would be expected to halt tightening immediately and perhaps even signal imminent cuts to support the economy. So initially, what would you see? Probably a sharp rally in bonds, pushing yields lower.
In tech stocks.
And probably a reflex rally in rate-sensitive technology stocks on the promise of cheaper money, lower discount rates.
Okay, so far so good for tech.
But that initial excitement very quickly evaporates as it collides with a far greater fear, the fear of a genuine, hard economic landing.
The growth fear takes over.
Right. If the job market is actually collapsing, it means the entire customer base for companies is shrinking and the corporate earnings outlook is deteriorating rapidly. So the broader market, especially the S&P 500 and the economically sensitive Russell 2000 small cap index, they sell off aggressively.
On concerns over collapsing future revenue and margins.
Exactly. The Fed being dovish doesn't help if nobody's buying your products because they lost their job.
That tension is the core dynamic then. Even if the Fed is suddenly friendly, a recession is still fundamentally bad for business, for earnings.
Precisely.
Why is the small cap Russell 2000 the most vulnerable index in that recessionary scenario? Let's single it out.
Yeah, the Russell 2000 is typically dominated by smaller companies. They tend to have higher domestic U.S. exposure compared to the big multinationals in the S&P 500.
More reliant on the U.S. economy.
Much more. And often they have higher debt loads relative to their earnings. They are far more dependent on the immediate health and growth of the U.S. consumer and the domestic economy.
Less diversified globally.
Exactly. So if the domestic economy is genuinely in trouble, small caps get hit first and hardest. This scenario leads to massive volatility and intense sector rotation. Maybe defensives like utilities or consumer staples hold up, perhaps bonds win big, but almost everything else struggles to find direction amidst the conflicting signals. It's messy.
Okay, let's shift gears slightly. Let's move away from the overwhelming macro picture for a moment and look at some company-specific insights, especially since, as you noted, the earnings calendar for the big S&P 500 components is notably light today.
Yeah, not much big cap earnings news.
So when the big earnings aren't dominating the headlines, we sometimes get a clearer look at global sector health through maybe international bellwethers or smaller company reports.
Exactly. And the micro-level insights, particularly from international industrial bellwethers, can be crucial for understanding things like global capital expenditure trends. And we actually received some very positive news on that front from Japan's Yaskawa Electric, 6506JP.
Ah, the big industrial automation and robotics company.
That's the one, a giant in the space. Yaskawa reported its Q2 operating income, and it comfortably beat the consensus estimate.
What were the numbers?
They delivered $12.83 billion versus an estimate of $10.24 billion. So a solid beat.
Nice.
And furthermore, critically, they raised their full-year forecast, they bumped up guidance.
Okay, that's significant. What's the read-through there?
Well, this company is a strong global bellwether because they sell the tools, the robotics, the industrial drives that other companies use to build factories and automate their processes.
So their success implies others are investing.
Precisely. This beat and raise suggests that global capital expenditure, or CapEx, and industrial demand, particularly in Asia where they have strong exposure, remain surprisingly healthy, despite all the widespread concerns about a global slowdown.
So manufacturing isn't falling off a cliff everywhere.
It seems not, at least based on this data point. It's a constructive signal for manufacturing and robotics globally.
Okay, that's a great read-through on the supply side, the industrial side.
Mhm.
We also have a crucial consumer read-through happening in the UK today, which might give us some insight into those wage pressures in service industries, the same pressures driving U.S. inflation concerns.
That's right. That's the UK pub chain JD Wetherspoon, JDWGB, which is scheduled to report today.
Okay, a pub chain, how does that connect?
Well, while they don't directly impact the U.S. market, of course, analysts will be parsing their commentary very carefully. They'll be looking for key insights into European consumer resilience, how people are spending.
And costs.
Absolutely. Specifically, they'll be looking at how Wetherspoon is managing rising costs. Think energy bills, food costs, and most importantly for our discussion, wage inflation.
Ah, there's the link.
Yeah. Their experiences with labor costs, attracting and retaining staff, and how that impacts pricing and customer volume. It provides an excellent parallel to the U.S. service sector labor dynamics we were just dissecting. It's a real-world case study.
Interesting. Okay, now let's pivot back to the U.S. pre-market, but focus on the retail trading side. Our sources describe a distinct bifurcation happening right now.
Yeah, a split.
On one hand, broad market caution from the institutional capital, the big players waiting for 8.30. But on the other hand, a surge of speculative fervor in the small and microcap segments.
The Wild West.
Kind of feels like it. This is the algorithm and retail investor sideshow, maybe, operating while the big money waits on the sidelines.
That speculative fervor, often in stocks trading below $10, sometimes even below $1, is where a lot of the volume is concentrated right now. And the moves are dramatic, huge percentage gains.
Yeah, some big movers on the screen.
But it's really important for our listener to understand the nature of the catalyst behind these big percentage moves today. They aren't all created equal.
Okay, let's unpack a few key pre-market movers then. What's driving Aspire Biopharma, ASBP? It's a big volume leader this morning.
Right, ASBP. It had a surge, maybe around 25% earlier, but its move isn't based on a single piece of fresh, hard news today. It's more based on a strong confluence of compelling narratives that have been building.
Narratives, okay, like what?
Well, they recently shored up their balance sheet with some crucial funding, which gives them runway. They reported some positive early clinical trial results for an investigational sublingual aspirin, so medical potential, and they are aggressively pushing their consumer supplement, the BUZZ Bombree workout. Catchy name.
BuzzBomb, okay.
So you've got this combination: clinical hope, improved financial stability, and this catchy branding on a consumer product. It makes a perfect cocktail for speculative retail interest. It offers both a potential big win story from the drug development side and a tangible consumer product link people can relate to.
Got it. Narrative driven. What about Dragonfly Energy,
Yeah.
DFLI? That seemed maybe more fundamentally driven.
It is, yes. DFLI operates in the lithium-ion battery space, specifically for RVs, marine off-grid applications. Their move seems more tied to verifiable fundamentals.
What fundamentals?
They announced an expanded partnership with Airstream, the iconic RV manufacturer that's a major customer validation, signals strong real-world demand in their core end market.
That's tangible business.
Exactly. And they also just secured a new patent for some advanced charge control technology, which helps their competitive positioning. This builds on an already strong foundation. Remember, their Q2 sales showed a solid 23% year-over-year increase.
So, real progress driving that stock.
Seems like it. Improved competitive positioning, validation from a major customer, solid growth track record. More substance there.
Okay. Then there's the poster child for just pure volatility today, Cheer Holding, CHR. It was posting one of the most dramatic gains, up over 50%, maybe 54%. What on earth is behind that kind of movement?
Yeah, CHR. That is almost certainly a technical bounce, probably a short squeeze. It looks entirely disconnected from any fresh fundamental news this morning.
What happened before?
Well, CHR suffered a catastrophic decline, something like over 70% in the previous session. just collapsed.
Wow. Okay.
So when a stock falls that hard, that fast, short sellers pile in, betting on further losses or bankruptcy. Today's massive spike is likely technical volatility, triggered by those shorts getting squeezed out, forced to cover their positions as the stock bounces.
Any other factors?
Well, it's fueled by the fact they recently held their AGM and approved some corporate actions, like increasing the number of authorized shares and potentially doing a reverse stock split. These kinds of structural changes often fuel highly speculative, high-risk trading movements.
So it's pure gambling on momentum and technicals.
Pretty much. Very high risk, driven by market structure, not business results today.
Got it. And finally, XL Brands, XELB, also up sharply. But this one due to analyst action, right? A reminder that a single institutional voice can immediately shift the conversation for these small caps.
Absolutely. XELB surged, I think, over 46% earlier, directly because the Maxim Group initiated coverage on the stock.
What do they say?
They initiated with a buy recommendation and a highly aggressive price target. The target implied, get this, a staggering over 400% upside from its recent closing price.
400% upside. Wow.
Yeah. Now, for a small cap company, this kind of bullish initiation from a recognized research firm, particularly with such an exaggerated upside projection, acts as a powerful immediate catalyst.
How so?
Well, it draws institutional attention, it triggers algorithmic buy signals based on analyst ratings, and it immediately shifts the narrative around the stock, regardless of whether the stock actually ever hits that price target.
The initiation itself moves the needle today.
Exactly. It's an immediate, high-stakes attention grabber. Puts the stock on the map for a lot of traders. Hashtag outro.
So, okay, let's try to synthesize everything we've covered this morning. The narrative remains crystal clear, doesn't it? We are operating under this fragile optimism.
Very fragile.
That is entirely contingent on the outcome of the 8:30 a.m. ET employment data. Specifically, as we've drilled down, that wage component.
Average hourly earnings, yeah.
And the small cap churning we see, these big percentage gains in ASBP, CHR, XELB, despite the massive moves, it really remains a sideshow, doesn't it? Until the big macro picture resolves.
Absolutely. It's noise relative to the main event. And the source material is very explicit on the final strategic consideration for you, the listener, today. Trading today based purely on these idiosyncratic stock catalysts like a new patent or that Maxim analyst recommendation or buzz bomb pre-workout carries elevated, perhaps even unacceptable risk right before this jobs number hits.
Why unacceptable?
Because a significant macro surprise, either that hot report or the recessionary report we outlined, can easily, instantly overwhelm any positive company-specific news. It can turn these pre-market winners into post-data losers in a matter of minutes, just as broad capital flows shift based on fear or changing rate expectations.
The macro tide lifts or sinks all boats, basically.
Especially on a day like today, the company news gets swamped.
Therefore, what's the most prudent approach for the listener heading into this critical data release? What's the smart way to play it or maybe not play it?
Well, look, for the majority of participants today, the most prudent approach is often patience. Maybe frustrating, but prudent. Observe the market's initial reaction, and I don't just mean the first minute spike or dip.
Look deeper.
Look deeper. Watch the full picture unfold. How do yields react? What does the VIX do? Which sectors are leading or lagging after the first hour?
Let the dust settle.
Exactly. The true, sustainable trend for the session is often established after that initial volatility subsides. Typically, maybe an hour or two after the opening bell. That's when large institutional players have fully digested the full breadth of the data and completed their necessary portfolio repositioning.
So wait for their signals.
Waiting for that clarity for the market to show its hand after the initial noise is often the best defense against getting caught on the wrong side of a violent, data-driven reversal.
Makes sense. Patience can be a strategy.
It absolutely can be. And maybe here's the provocative thought for you to chew on today as you watch those 8:30 a.m. numbers hit the tape.
Okay, leave us with something to think about.
We spent a good amount of time detailing how a strong jobs report, scenario B, can actually be bad news for high-growth stocks because of rising interest rates, right?
Right, the valuation compression.
But what if the opposite occurs? What if we get a truly recessionary report, scenario C? We noted that initial dovish excitement, the potential for lower rates. But here's the question. Will that immediate excitement, the Pavlovian response to an immediately dovish Federal Reserve, Will that ultimately overcome the sheer terrifying fear of a genuine hard economic landing?
Meaning, will tech stocks fall anyway?
Will even those rate-sensitive technology stocks ultimately fall due to rapidly deteriorating concerns about collapsing future corporate earnings in a recession? Which force wins the tug-of-war today? The central bank promise of potentially easier money or the harsh economic reality of a potentially shrinking economy?
Policy versus reality.
That is the fundamental tension the market must resolve this afternoon if we get that scenario C print. Something to watch very closely.